Welcome to the Pro Ticker Deep Dive.
For years, whenever you talked about the global auto industry, well, the conversation always seemed to land on China. This huge market, seemingly unstoppable growth, especially with new energy vehicles, NEVs. But now, we seem to be standing at a real inflection point. That countdown clock on the big government subsidies is ticking down. The domestic price wars are just brutal. And investors, well, they're asking that big question. Is 2026 the year the boom finally, stalls out? Or is it just shifting gears into something tougher, something more about global competition?
That tension is exactly why we need this deep dive. We're looking at sources projecting, a significant recalibration. It's a move away from just chasing volume at any cost. The focus now seems to be shifting towards margins, towards strategic growth. Our mission here is to really dissect why that domestic engine is cooling off and, crucially, how exports and high-end tech are supposed to cushion that blow. So here's the bottom line for you right up front. Wholesale passenger vehicle growth. It's projected to drop sharply, actually, next year. But this slowdown, it's forcing companies into really aggressive globalization. Think overseas manufacturing, premium exports. That looks like the strategy to save margins for the big players. It's a fundamental shift in where the profits are coming from.
Okay, let's unpack that. We absolutely have to start with the domestic slowdown. That seems to be the fundamental drag on momentum right now. The era of easy money, as you said, it's gone. What specifically is driving this expected deceleration?
It's really a potent mix. Policy and macroeconomics hitting at the same time. The single biggest factor, that policy cliff, the purchase tax breaks for NEVs. They're scheduled to completely roll off by the end of 2025.
Right, the end of 2025. And the impact.
Think about it from the consumer's perspective. The buyer tax, which has been 0% for ages, it jumps back up to 5%.
5%, okay.
Yeah. For a mid-range EV, that's a direct cost increase. Thousands of dollars, potentially. It's an immediate, pretty tangible disincentive, especially if you are maybe on the fence about buying.
And we can't ignore the broader context either, can we? We're already dealing with slower overall economic growth. Consumers seem much more cautious these days.
Exactly. If people are putting off basic purchases, they're definitely thinking twice about big-ticket items like a new car.
So those massive stimulus boosts we saw, that's over.
Definitely over. Which leads us to a really interesting concept the analysts highlight for understanding 2026, this idea of pulled demand.
Pulled demand. Okay, explain that. If analysts think, 2 million units of demand were pulled forward, doesn't that mean 2026 is facing more than just a slowdown, like a guaranteed slump?
Yeah.
Is that baked into the forecasts?
It is baked in. That's the key point. The subsidies didn't necessarily create millions of new buyers out of thin air. What they did was accelerate purchases for people who were likely planning to buy anyway. They rushed to buy in 2024, maybe early 2025, specifically to beat that tax deadline.
I see. So they just bought sooner than they otherwise would have.
Precisely. So when that forward momentum just stops, the market effectively loses the support of those 2 million buyers who've already made their purchase ahead of schedule. And as a result, the forecast for 2026 looks much softer. We could see a wholesale passenger vehicle growth drop from around, say, 7% this year, maybe all the way down to about 3% next year.
Wow, 7 down to 3. That's a big drop.
It is. And retail sales, expected to be flat, maybe even slightly negative. That's a huge psychological shift for a market that just got used to constant expansion.
That is a brutal correction. But you mentioned a potential silver lining, something about policy. Even if the blanket subsidies end, maybe targeted incentives.
Exactly. The sources suggest Beijing might pivot strategically, away from just rewarding sheer volume,
So less broad strokes, more specific targets.
Precisely. Instead of just subsidizing any NEV, they might target incentives based on energy efficiency, maybe technical performance. And this is a really key nuance. This kind of policy would heavily favor, say, high-performance EVs or specific plug-in hybrids that can demonstrate really low fuel consumption or outstanding range.
Okay, so rewarding the tech leaders.
It's a strategic move. Away from just pure EV volume, more towards real-world sustainability and hitting specific tech benchmarks. So maybe energy-hungry models lose support, but the high-tech, efficient ones keep a competitive edge.
Okay, but this slowdown, it doesn't mean innovation itself is stalling out. Let's look inside the NEV sector specifically. Even if volume growth cools, the overall penetration rate, that's still climbing, right?
Oh, yeah, the shift is relentless, even if the pace is, let's say, less explosive. NEV sales growth, It's expected to slow from roughly 27% this year, maybe down to 15% next year.
Still double digits, though.
Still solid double-digit growth, exactly, but just, less frenetic than what we've seen. And the penetration milestone is really fascinating. NEVs are still seen as on track to hit maybe 58% of the total passenger vehicle market by 2026. That's up from about 53% today.
58%, that's huge.
It shows the consumer commitment to electric or electrified vehicles is pretty firm, even with the headwinds.
And what about the mix within NEVs? Are pure battery electrics, the BEVs, still dominating? Or are plug-in hybrids making ground?
BEVs will remain dominant, yes, but the sources note an interesting potential shift in the long-term forecasts. Plug-in hybrids, and that includes ERVs, they might actually slip a bit, maybe account for about 1/3 of total NEV sales long-term.
Oh, interesting. Why?
Potentially reversing some of their recent momentum as, charging infrastructure keeps improving and battery tech gets better and cheaper.
Right, right. And all this cooling growth, combined with that high penetration, it leads us straight to the core instability, doesn't it? Pricing pressure. It sounds almost desperate sometimes. I mean, when you hear about companies signing anti-involution pacts just to stop undercutting each other, the pressure is existential.
That's exactly what that anti-involution campaign in mid-2025 was about, trying to cool what analysts were calling irrational price wars. And while there might have been a slight tartaning of discounts right after, the fundamental, almost toxic problem, it remains unsolved. And that is just massive overcapacity.
Remind us about the scale of that overcapacity again. The numbers are pretty staggering.
They really are. This is the root cause of the fragile pricing. Supply just far outstrips current demand. Installed auto capacity across China is somewhere around 50 million units annually.
50 million, okay.
In production.
Annual production is closer to, say, 33 million units.
So a 17 million unit gap. 17 million units of difference. To put that in perspective for you, that's enough idle capacity to build basically every single car sold in Western Europe last year. Just sitting there.
Yeah.
That massive supply glut, it basically guarantees continued discounting, it keeps pricing relentlessly volatile, and makes profitability incredibly difficult, at least domestically.
So if the domestic market is slowing and pricing is guaranteed to be hostile, what does this mean for manufacturers trying to stay profitable? The sources point to exports being the new lifeline.
Absolutely. Exports are no longer just a side business. They are the financial shock absorber for the whole industry now. Overseas markets, you're looking primarily at Southeast Asia, Europe, and Latin America. They've rapidly become the major profit center for these companies.
And that profitability detail is just remarkable, exporting cars at 2 to 3 times the price they get back home. That spread sounds like the difference between surviving and, well, not surviving for some.
It is the defining financial metric of this transition phase. Because they're constantly under pressure to discount domestically, that huge margin difference they get abroad is absolutely critical to their P&L. For the key players, think BYD, Geely, Great Wall Exports are expected to account for a massive 30 to 40% of their total earnings in 2025.
30 to 40%. Okay, that explains the strategic priority shift then.
Completely.
But that strategy itself, exporting huge volumes at premium prices, doesn't that scream political risk? How are companies dealing with the trade tensions it inevitably invites?
And that immediately explains the shift in their expansion strategy. They aren't just shipping cars anymore, they're moving production overseas.
Like building factories abroad.
Exactly. Overseas manufacturing is now the key strategic hedge. It's about mitigating those looming geopolitical risks, especially tariffs. You look at the EU, right? They just launched that anti-subsidy probe. It's widely expected to result in pretty heavy duties, probably landing right in 2026.
Just when exports need to be firing on all cylinders.
Precisely. So the response. Produce locally. The sources mention new plans set to ramp up in 2026. Indonesia, Brazil, Hungary are examples. This isn't just about market access anymore. It's about shifting production inside potential tariff walls. It's really the ultimate hedging strategy against those geopolitical storms.
Okay, so beyond geography and volume, companies are also betting heavily on technology. Trying to create competitive advantages when just selling more cars domestically is getting harder. What specific tech differentiations are becoming the key battleground?
Yeah, this is how they try to escape that commodity trap, the one created by all that overcapacity. And we're seeing sort of two distinct paths emerging. Take BYD, for example. They seem to be leaning heavily on core component superiority.
Hardware focused.
Very much so. They're promoting things like their fast-charging 5C battery systems and LiDAR-based ADAS advanced driver assistance systems. That 5C refers to the charging rate, meaning theoretically they can charge 5 times faster than their capacity allows. It basically slashes charging times, which is a huge consumer pain point, right?
Yeah, definitely. So that's the hardware play. What about the software side?
Well, then you look at a company like XPeng. It's considered more of a high beta growth name. They're betting heavily on the, let's call it, the futuristic software layer. Full autonomous driving technology, even introducing humanoid robots into the mix. They're trying to position themselves almost as a technology platform first and a car company second. Capture that investor imagination for future markets.
And the goal of all this tech push, it's clearly tied back to brand premiumization, isn't it? Which then feeds back into those crucial export margins.
Exactly right. Tech differentiation directly supports higher margins. As these brands build credibility overseas, especially in demanding markets like Europe or parts of Southeast Asia with superior tech, well, they can command higher prices, build stronger brand loyalty.
So the playbook seems clear.
It really does. The future relies on balancing that innovation push with disciplined, margin-focused growth. Companies just chasing domestic volume, they're likely going to struggle. Those focusing on profitability, developing globally relevant technology, they're the ones positioned to thrive in this tougher environment.
So as we head into this transition, what are the really major risks investors should be tracking? Because relying on exports, plus volatile domestic pricing, plus geopolitical tensions, it sounds like a bit of a perfect storm for policy risk.
You really have to watch 3 main risks very closely. First, policy uncertainty. If Beijing fully ends all the subsidies without immediately replacing them with those targeted efficiency incentives we talked about, well, you could see a demand dip that's even steeper than currently forecast.
Okay, that's risk one.
Second, price wars 2.0. That 17 million units of overcapacity we discussed, that's the single biggest structural risk hanging over the market. It means pricing stays fragile. Fierce competition is basically guaranteed regardless of any government talk about anti-involution.
The capacity dictates the competition.
Pretty much. And third, global geopolitics. That heavy reliance on exports makes them directly vulnerable to protectionist measures, especially from North America and Europe. That could rapidly wipe out those hard-won overseas margins.
And when you connect all this back to the financial markets, the MSCI China Auto Index, historically, it moves pretty much in lockstep with sales momentum, right? So deceleration almost certainly means the sector lags the broader market.
It does suggest that, yeah. For investors looking to apply this knowledge, the technical markers for the key players become incredibly important. Take BYD, it's been consolidating. If it holds support near, say, HK $100 to $105, the catalyst for a breakout won't just be better Q4 results. It'll be proof that their 5C tech is scalable, exportable, and justifies that premium valuation internationally. Resistance looks to be around HK $125.
And XPeng.
XPeng remains that high beta name. It's really trading on future potential. Its path hinges almost entirely on investor confidence that its autonomous driving and robotic stuff is actually commercially viable down the road. If they don't deliver on those software promises, the stock's exposed.
High risk, high reward. What about NIO?
NIO sits firmly in that high-risk reward bucket, too. It desperately needs a catalyst, something definitive. The January launch of their new ONVO L80 model. That's potentially a critical turning point. If that new line doesn't achieve significant volume pretty quickly, the capital strain on the company increases significantly.
A lot riding on that launch, then.
A huge amount. So to kind of synthesize the big picture here, 2026, it won't be a rocket year for the China auto market. We should expect volatility. The market is clearly moving away from that subsidy-fueled chaos towards an era defined more by scale, by technology, and critically, by export strength. It's an evolution, really, but one driven by some necessary pain.
And that implies the winners in this next cycle. They probably won't be the ones just undercutting everyone else domestically or riding the last wave of subsidies. They'll likely be the players moving more quietly, maybe, laying down that overseas manufacturing infrastructure, leveraging AI-driven ADS to justify premium prices abroad, effectively escaping the domestic bloodbath. So this isn't really a stall. It's more like a necessary, maybe even painful shift in gears.
See you all in the next ProTaker Deep Dive.